This is JD, and I want to walk you through a specific trade I'm currently looking at involving Strategy's preferred stock STRF. I'm calling it the STRF Carry and Capital Appreciation Trade. This video is for entertainment and educational purposes only and does not constitute financial advice. I'm not a financial advisor. The strategies discussed in this video involve significant risk, including the potential loss of capital. Please conduct your own due diligence and consult a certified professional before making any investment decisions. This trade relies on two things happening. First, the risk-free rate drops, and second, Strategy's credit risk improves. This will happen over time, and the nice thing about this trade is while we're waiting for these two rates to drop, this trade earns a carry yield currently about 9.2%. So my price target for STRF at the end of this trade is $200+. Currently, STRF is trading just under $110 with an effective yield of 9.2%. Below, you'll see the perpetuity formula, which is used to calculate the price of a perpetual preferred stock with a fixed annual dividend. And as you can see, the dividend is divided by the required yield. So as that required yields drop, the price of STRF will increase. If you're not familiar, STRF is Strategy's senior most perpetual preferred stock. STRF offers a 10% dividend annually, payable quarterly in cash. STRF has governance rights and a dividend rate step-up penalties in the event of missed dividend payments. As you can see, STRF was trading at $108 today. There is about $1.2 billion under management, and the average trading volume is about $32 million a day. The 6.4x Bitcoin rating means Strategy has Bitcoin amounting to 6.4 times the notional value of STRF and all shorter or senior instruments on their balance sheet. STRF currently occupies a premium position in the capital stack, subordinate only to convertible notes. Management has indicated a strategic shift. They will cease issuing new convertible notes and allow existing notes to run off the balance sheet. Consequently, STRF is poised to become the senior most preferred equity. As this transition occurs, the perceived credit risk of STRF should decrease, likely serving as a catalyst for price appreciation. As depicted by the company's rocket ship visualization on the right, the business model relies on Bitcoin functioning as a nuclear reactor. Bitcoin appreciation is leveraged to fund dividends across the preferred stock suite: STRF, Stretch, Stream, Strike, and Stride. Depicted in green is their US dollar reserves to ensure sustainability and market confidence. The company maintains a 1.4 billion USD reserve that equates to approximately 21 months of dividend coverage, effectively mitigating concerns regarding payment viability. The company utilizes three primary mechanisms depicted by the boosters to generate the yield required for these dividends. First, issuing MSTR common stock. Second, liquidating Bitcoin holdings. And third, tapping into Bitcoin derivatives. I will link the full video in the description below of Michael Saylor explaining this rocket ship analogy. This sensitivity table models the projected price of STRF based on two primary inputs, the risk-free rate and credit risk premium. The data illustrates a clear inverse relationship. As credit risk perception improves and the risk-free rate declines, the fair value of STRF increases. The sensitivity table highlights the potential for significant asymmetric upside should these two variables compress simultaneously. Currently, Strategy holds a B- credit rating, which theoretically corresponds to a 4.42% credit spread as shown in the reference table to the right. However, at the time of this analysis, STRF was trading at $102, reflecting a significantly wider implied spread of 5.84%. This dislocation suggests that the market was pricing STRF with a higher risk premium than the company's credit rating would typically dictate. My target entry is structured between $102 and $119, denoted by the black boxes in the chart. This range capitalizes on the current market inefficiency before the spread normalizes. Risk management is anchored by a hard stop loss at $81. A price deterioration to this level would invalidate my investment thesis, likely signaling a fundamental shift in the macro environment, specifically either an expansion of credit spreads or an increase in the risk-free rate, or a combination of both. Upon achieving a 30% unrealized gain, I will begin to layer in the levered exposure. This ensures that margin is only utilized once the trade has been de-risked by initial price appreciation. My price targets are in the green box and the teal box. The green box is my base case. I project a realistic price target of $207 within an 18-month time horizon, assuming the anticipated credit upgrade and the risk-free rate drops occur. My bull case outlined in the teal box represents a theoretical upper bound of this trade, assuming maximum compression in both the rate and risk factors. This trade will be financed via a $40,000 loan taken out from my Roth TSP, a federal version of a 401k. The loan carries a 4.25% interest rate over a 60-month term, resulting in a monthly debt service of approximately $740. The 4.25% rate does not represent the cost of funds, as these interest payments are repaid back into my TSP account. The true economic cost is derived from liquidating the underlying assets, in this case the S&P 500. Therefore, the cost of capital is defined by the opportunity cost of the S&P 500's historical performance. So I've established a 10% hurdle rate for this investment. Any return below this threshold would result in a negative economic outcome compared to not executing this trade. Fundamentally, this transaction represents a risk rotation. I'm effectively swapping broad equity market risk, the S&P 500, for strategy's corporate credit risk. There are a lot of risks associated with this trade, and I've listed 18 of them here. I won't go through them individually. Maybe in future videos I'll go through them. But pretty much I was hoping this is where you could come in, and if you see I'm missing something, please let me know in the comments down below, and I'll be sure to address them in a future video. I plan to execute this trade starting on December 2nd, 2025. I will initially allocate $20,000 followed by a weekly dollar cost average of $5,000 for 4 weeks. This trade will start with zero margin. Leverage will only be introduced once the position secures a 20% unrealized gain. At that point, I will maintain a conservative 1.3x exposure to respect the strict 50% maintenance requirement imposed by my brokerage on STRF. To manage risk, I will rely on mental stop losses rather than automated orders to avoid being wicked out. I have defined a hard invalidation level at $80 to start, and then a manual trailing stop after the position becomes profitable. Other exit triggers include changes to STRF's position and strategy's capital stack, a bid-ask spread expansion, a deterioration of daily volume, or a degradation of strategy's Bitcoin or USD reserves. I will continue to refine my models and research the securities and their risk. This concludes my current thesis and execution plan for the STRF trade. As mentioned, this is a living model. This is my raw research and current roadmap, but the market remains dynamic. I want to hear your perspective. Do you see any flaws in my analysis? Are there risks I have overlooked? Please leave your thoughts and comments below, as I want to generate a real conversation to refine this thesis together. If you want to track the performance of this portfolio and follow the journey over the next 18 months, make sure to subscribe and hit the notification bell.